The Federal Reserve raised interest rates Wednesday for the seventh and final time this year. This time, the central bank increased rates a half a percentage point, a smaller hike than in previous months. The Fed's goal is to try and lower inflation, which has been moderating for 2 months straight. For more on the Fed's move, David Wessel joins me now. He is the director of the Hutchins Center on Fiscal and Monetary Policy at the Brookings Institution. So, David, let's start with something that Jerome Powell, the Fed chair, said about rate cuts. He said this on Wednesday. Let's listen.
Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way.
David, what does that mean?
Well, there were some people in the markets who were hoping that the Federal Reserve would raise interest rates a couple of times more, but by the end of next year would begin cutting them. And what Chair Powell said today is, forget that, we're not doing that. The Fed is on track to raise interest rates to more than 5% next year. And Chair Powell has made clear that he expects to hold rates there for some time until he and his colleagues are convinced that they've really beaten inflation into the ground.
And so we think of both what the Fed did on rates today, but then also this is a strong signal being sent about the future so that nobody makes any mistakes. And what's that about? That's about getting into the heads of employers, purchasers, so that they don't let up on the behavior that Powell hopes will bring that inflation number down. Is that roughly it?
Basically. So there are two things going on here. One is inflation, although it's started to moderate a little bit, remains well above the Fed's target, and it's been more persistent than the Fed had anticipated. So they're running to catch up to that change in the outlook. That's what accounts for saying we're going to raise rates a couple more times next year. But the second part is exactly what you said. The Fed wants us all to believe that they will get inflation back down towards 2% no matter what. And they're doing that because they don't want us to anticipate that they will fail. Because if we anticipate they will fail, we will ask our employers to give us bigger raises, businesses will begin to plan on that, and what the Fed and other economists call inflation expectations will get unmoored. And so that's what they're really worried about. Modern central banking is very much about containing inflation expectations. It's what makes this episode so different from the one that Paul Volcker confronted in the early 1980s, when the Fed didn't think so much about inflation expectations, but they had really infected the economy.
And along the lines on those inflation expectations questions, I hear a lot of economists or people maybe who are wishful thinking saying, why be so obsessed with 2% inflation? Can't we handle 3%? And they make some arguments for that. I would think also that that's something that the Fed would want to smash into the ground because they don't want anybody thinking that 3% could be tolerated or 4%. But is there an economic reason why 2% is the magic number?
Right. So that's a really good question. The Fed thinks it's important to stick to the 2% target because they don't want to be accused of moving the goalposts. But there are a number of economists who say there never was a really good reason to pick 2%. And the world has changed a lot since that decision was made. We've bumped up, interest rates have bumped up against zero much more often than people have anticipated. So there are lots of outside economists who say, like, look, let's not do this now, but when the Fed gets down to 3%, maybe it would be a good time for them to redefine their target or sort of fudge the timing at reaching 2%. So I think that's an argument we're going to have, but it's not one the Fed wants to engage in now, and for good reason.
Final question, David, is on wages. Chair Powell has said that wages are rising and that's part of one of the things he sees as a bit of a problem. Can you walk us through what's happening on wages? And I thought good wages going up was a good thing.
Well, it is a good thing, especially if it's your wages who are going up. Chair Powell thinks that wages are rising too fast to be consistent with his 2% inflation goal. And he's afraid that if that continues, that then businesses will raise prices and we'll all expect inflation. Now, it's hard to hear because for many Americans, real wages adjusted for inflation are actually not rising. It's really taking a bite out of people's standard of living. Chair Powell came to Brookings a week or so ago, and I asked him about this, and I said, look, what would be so wrong with inflation rising a little more than normal for a while so people could catch up, which is a view that a number of economists I respect hold. And he just doesn't see it that way. He's convinced that the only way to assure that we get inflation down towards their target is to slow the pace of wage increases. He's going to keep raising interest rates until the labor market weakens, and it'll be harder for workers to get raises. That's his explicit strategy, like it or not.
Like it or not, indeed. David Wessel, we're so grateful to have you here. Thank you.
You're welcome.